This bond's earning 7%. What's the catch?
Brian, I am super excited about this show because I feel like we've been getting tons of questions around this, whether it be from our audience, I see them in the chat, I see them at YouTube, and even we've had clients reaching out like, hey, I've heard about this thing, this mystical, magical thing. Is this something that I should maybe be taking advantage of?
Well, look, it's hard to get safe returns right now because I think because interest rates are artificially super low, there's a lot of incentive that the government has put on us to go out on the risk spectrum. To really get return, you have to go buy equities, you have to do real estate, you have to do other things. If you're buying bonds, it's a little scarier. So then when you find out that there is a bond that is guaranteed by the government that currently needs to probably go in quotes because it's a very unique thing, is paying over 7%. We want the Money Guy audience to know what's going on.
Well, and then when you add to that, one of the things that most consumers are concerned about, worried about, hot button topic is inflation. Oh no, what are some good ways for me to combat inflation? How do I protect myself against that? Well, enter this conversation on I-bonds. Oh, here's this thing, and it's going to be your solution for inflation.
So first, a lot of you who already support FTE Daniel with his Substack writings, if you go to FYI by FTE, it's on Substack. I think we have lots of links if you go to moneyguy.com.
You go to fyi.moneyguy.com to direct straight there.
So there is actually, Daniel's written on this, and it did so well. We were like, we ought to cover this in a Q&A show. But Bo, first we ought to talk about because the bonds we're talking about specifically are I-bonds.
That's right.
And here's the thing. I-bonds, if the layman's way to understand this is that they're going to keep up with inflation, plus, in theory, give you a little bit more, but we're going to let the CFA here tell us what are actually I-bonds.
Yeah, so essentially it's a bond issued by the government that really has two components. There is a fixed interest component that is guaranteed and locked in over the maturity of the bond. And then there's a separate component, a second component, that actually adjusts with inflation. So as we see inflation happen, the bond actually pays a greater rate of interest. So there are two components the way you actually make money or earn interest on an I-bond.
So we're professional financial advisors. We have clients. We help manage their portfolios. I think it's important for us as advisors to share, but also for the public. Why are I-bonds suddenly so popular?
Yeah, and you may say, oh, are they really that popular? It was interesting. Daniel found this, and I thought it was fantastic. This is the search interest, according to Google, in I-bonds from 2012 all the way until 2021. Data showing how much are people looking for this. Well, you can see as we got into 2021, people are looking up, what are I-bonds? How do I use I-bonds? Why do I-bonds make sense? A lot of people seem to be asking these questions about these specific securities.
So based upon this graph, for those that are not on YouTube, for out there in the podcast land, I can go ahead and tell you prior to the end of 2021, right at the beginning of 2022, kitten videos were much more popular than I-bonds. So this is only recently, and it's really had a 5 to 6 fold increase in interest. So that means obviously things have changed. So Bo, kind of walk us through what are some of the things that have actually influenced this?
Yeah, so the big question is why has this become so popular? And it's because the thing that you've heard is because of the way that I-bonds work, there has actually been a spread over what normal savers can earn on their savings accounts. If you look at this is a chart. If you're listening out on iTunes or iHeartRadio or Stitcher or Spotify, this shows from 2012 until 2021, it shows the federal funds rate. And the federal funds rate is just the overnight rate that banks charge each other to borrow or lend. And so it often relates to what we can earn on our high yield savings accounts. And you can see that from 2012 until about 2016, it was pretty flat. And then in 2016, rates began rising. And right there in 2019, a lot of money market accounts and savings accounts were paying as high as like 2.5% interest, which was really, really exciting. Well, if you look at the other line, the green line that's overlaid there, it shows the composite, the total rate that you could earn on an I-bond. So while there was a 3% spread on I-bonds over the federal funds rate back in 2012, it quickly went away. And there's actually been times where savings rates were paying more. But you can see now that the Fed funds rate has been held close to zero, near zero, and inflation has begun to rear its head, there's a huge spread between what you can earn on I bonds versus what you can earn on just a regular standard old savings account.
So let me get this straight. So I can see on the chart here, I bonds are now paying over 7%. Is this like one of those things you hear about, those unicorn situations where people in like 1981, 82 had CDs that were paying 11% for 30 years? Do you get to keep 7% for forever?
Not at all, because what happens is it's actually adjusted for inflation every 6 months or so. So as inflation comes down and goes away, that 7% number will change. And here's what's really, really interesting. Remember, I bonds have these two components. There's a fixed interest rate, and then there's the one that adjusts with inflation. Right now, the fixed interest rate on I bonds is 0. So you're locking in a 0% return on that portion. All you're getting is the move in inflation through time.
So it's really only because the government has stated CPI is high.
That's right.
That I bonds are getting this huge benefit. And realize, and look, I said this, and I think a few eyebrows in the content meeting were raised. We all know CPI and other inflation indicators that the government uses are manipulated.
Yep,
I'm just going to go ahead and tell you because, and why? That's not some conspiracy theory. That's not, something you might see on one of your cable news and you have to adjust your politics to figure out where you are. It's actually because realize we have a lot of debt. A lot of the big governments of the world are in a lot of debt. So there's a lot of interest in keeping, literally interest, I know it's a pun, keeping the interest rates low so that the carry cost on all the national debt doesn't break the budget. So that's actually what's going on in the background. So be very leery. There's going to be a lot of incentive for the government to still continue to underreport inflation. I always say when we've done inflation shows, if they're showing 7%, as we all know, inflation's much higher than 7%. Right. But it also you need to be aware that they're trying to put their thumb on the scale to keep this number as low as possible.
All right, so we've talked a little bit about what I bonds are, how they operate, how they work. Well, now let's talk a little about, should this be a tool in your financial toolkit? Does this mean this should be something you should be utilizing to be a part of your financial journey? And we thought the best way to do that was to sort of lay out a T column of pros and cons. What are the good things?
The CPA in me gets excited when you do a T column. Keep going.
What are the downsides? So here's one of the pros of I bonds. Generally speaking, it's safer than stocks or corporate bonds because there is this inflation adjustment. Even if inflation happens, you'll be rewarded for that. So it is lower on the risk scale than like a bond issued by a corporation or than buying an equity type security.
Yep.
The other thing is because the interest rate does move with inflation, it does protect your purchasing power through time, right? If we see a highly inflationary environment, the interest will adjust accordingly every 6 months, so you get compensated for that. And then the other pro is that in unique times, I bonds can earn more than savings accounts or other bonds, which is going on right now. You can earn about 0.5% on a high yield savings account. You can earn 7% on an I bond. So there are periods of time where that spread is pretty attractive.
I mean, I feel like we're an infomercial almost for I bonds. There has to be, because right now, if I'm out there watching this, I'm like, whoo! I mean, 7%. I mean, my savings account right now is, like at an Ally or somewhere else, is like 0.5%.
Nothing.
So and you're like, man, to get FDIC type guaranteed, return, this sounds too good to be true. Let's give them the other side of the equation. What are the cons with this?
Yeah, so this is the first one. I bonds are an illiquid investment, meaning where you have your savings account and you can go pull money out as frequently or as infrequently as you need to. I bonds aren't redeemable until they've been held for 12 months. And then if you actually redeem them inside of the first 5 years, there's a 3-month interest penalty. So you have to actually give some of that interest back. So if you are saving for something where you're going to need these funds in the next year and the next couple of years, I bonds may not be the best solution for you.
Hey, also, now here's the thing. I'm riding every time I drive into Nashville. And you know the billboard I'm talking about. There is a local bank. I don't know if it's a local national bank, but they totally monopolize this one billboard on the way into Nashville. And they're always advertising that they have a savings interest rate on their checking accounts or money markets at like 3%. And I'm always like, woo, should I go open that account? Should I move it? And I find out that no, usually there's an asterisk on there. It's only on the first few $1,000s that I put there, and then everything else is peanuts like all other interest rates are. is that what happens also with I bonds?
Yeah, I bonds are the same way. The purchase limits, how much you can actually buy, is fairly limited. So for an individual, you can buy up to $10,000 per year of I bonds. Now, before you start writing in the comments, yes, you can go up to $15,000. You can buy an extra $5,000. But you have to do that using a tax refund, and when you do that, you're actually buying paper bonds, not electronic bonds, and you have to buy the bonds directly at Treasury Direct. So it's just, there are limits for how you get access to them, and even limits in terms of how much an individual can purchase of these bonds.
I want to put a kind of placeholder on something you just said, and I probably would have added one more con. I should have brought this up in the content meeting, and the fact you just said it. Mm-hmm. You have to buy this and hold it directly through Treasury Direct. Right. So I want you to hear me say that, and then when I come back in a minute and tell you, is this a good or bad thing for your personal portfolio, that's going to come into play.
And then here's the last con. Inflation interest rate changes every 6 months. So while you can be very excited about 7% right now, there's no guarantee that 6 months from now it's going to be 7%, or even a year from now or so forth. So you can imagine if you were to lock up some of your cash in this with a commitment to do it for 5 years, there's a chance that 5 years from now, savings accounts could be paying higher than your I bonds, where you're an illiquid security that you might not be able to move out of without a penalty.
And this is something I want to kind of draw a little attention to. We talked about this earlier, is that there was, like within the last 2 years, there was a period where your savings rate at like a Fidelity in their money market accounts, or if you went to one of the high yield, FDIC insured online banks, you could have gotten 2.5%. Yeah. But yet when we went and compared to what I bonds were paying during that period, they were like at 1%.
That's
so
right.
the government is doing everything in their power. So if we have a period where interest rates, and you've heard the Federal Reserve has said that we are in a period where they think that they just punted, they deferred for a little bit longer, but there's a really good chance interest rates are going to start going up soon. There's a chance, based upon historical things, I bonds might not be as lockstep with what you see happen when they raise interest rates.
So obviously, Brian, we're in the business of like giving personal financial advice and walking people through, like, does this make sense? Does this not make sense? What's your take? Does it make sense for everyone to go out there and purchase I bonds? Is it a solution that most folks should be taking advantage of?
Well, I want to save my opinion, because I want you to walk them through those first two things we talked about kind of when we were doing show prep on this, with time frames and other things. And then I want to talk about, based upon where anybody who's out there watching, I'm going to give you the actual measurable things based upon how much money you have under your control and how that pertains to you.
Yeah, realistically, if you think about the limitations, for most folks, it's going to be about $10,000 per year is what you're going to be limited to. And while 7% is more attractive than 0.5%, which you get in a savings account, that difference only amounts to about $650 in a year. So it's probably not going to be life-changing money. So you have to answer the question, what am I trying to have my emergency reserve do? If you really want your emergency reserve to be there and be available for you should an emergency happen, I bonds probably aren't the solution because they are illiquid. So what this means is an I bond might make sense for a short to intermediate term goal, and you have excess cash above and beyond your emergency reserve to do that. Well, then you have to answer the second question. Is the $650 of additional interest worth the steps it takes to actually put this practice into place?
Now you just said $650 difference. What were you talking about? What do you mean?
Yeah, so the 7% that you can earn on an I bond versus the 0.5% you can earn on a savings account for a $10,000 maximum amount that you could buy.
Yeah, so that's the number. So once again, it's kind of like the billboard on the side of the interstate. You find out the catch because of how limited it is, the liquidity. Let's boil this down to what it means for you specifically. If you're watching this content and you have less than $500,000 in investment assets, I think that your behavior is more important than the location. And that's why when we're always giving content to you guys, we're always talking about, hey, make sure you're focusing on your saving and investment rate. I want you to get to 20 to 25% of your gross income as fast as possible, and then leverage the simplicity of index target retirement funds, because they only require you to say, how much can you save? When do you need it? And then they do all the heavy lifting on the asset allocation. Take advantage of that. Now, take it over to the people who are on the other side of that. Maybe you have a portfolio that's over $500,000. You know, $500,000, $1 million, $2 million. You're hearing 7%. You're getting all excited. But here's the reality of the situation. It's just hard to do too much. It's hard to get really excited, because what I don't personally have these in my portfolio because I don't want one more account at another institution, because in my financial planning career, one of the biggest things I see when a prospect comes in the door is that they'll come in with the quilt of their financial life, where I can, they'll have a 401k that will have all the info and technology funds of the 90s. And I'll be like, well, I can tell you what you were doing in the 1990s. They'll have another portfolio over here doing something. They'll have separate accounts at, Janus or Vanguard or all these different places. And I'll be like, how is your plan actually working together? I see you have all these different components of the hot things that were going on in certain periods of time, but how does this all work together? And if you have your money floating out there in all these different pots, it doesn't work as easily. You're not maximizing the plan. And I'm just not going to go set this up for $10,000 a year or $20,000 between me and my wife, and then have to have all these hoops I have to jump through. I look at it more as a bank teaser rate, just like I'm not going to go sign up with that bank just because of the billboard they have on the interstate. I'm going to focus on my why and what I'm doing with the money. What's the purpose? How do I fine tune this engine to reach my financial goals faster? And look, this is something that's interesting, but it's more of a distraction than it's going to be the engine that's going to get me to my goals.
Yeah, I completely agree. That's not to say that it might not make sense for you or might not be something you want to pursue, but just like you said, Brian, the why is what you should follow to make sure it makes sense for you. So you guys know one of our favorite things to do, the reason we like to do these live streams is we like to answer your questions. So if you have a question, I have the team out on the wings. They are putting them on the spreadsheet for me. So we're going to go through and answer some of these. And our goal is to load you guys up with as much financial information as you can hold. So this first question, Brian, is very timely. This is from Andrew. Andrew says, if all of my stocks are down right now, but some are down more than others, would it be an okay time to rebalance the portfolio if I was planning to do it soon anyways? So he said two things I want you to speak there. One, he said specifically stocks, right? That's a different type of thing you got to think about as terms of like when you buy and when you sell. But how do we think about rebalancing? And how should someone, an investor, think about rebalancing their portfolio, and how does what's going on presently in the market affect that?
Yeah, I always say that there's several things going on, especially when markets are volatile, is that you want to have your plan based in what's opportunistic and what's long-term.
That's right.
So if you are planning because the long-term plan is, hey, maybe the allocation needs to be tweaked a little bit, or I just need to bring everything back into focus, that's your first hurdle you need to look at and go, yeah, I know I've got a rebalance coming up. There is nothing wrong with being opportunistic and locking in and harvesting some losses and other things because you're going to do it anyway. But I will go ahead and warn you, you have to be, we're not market timers. We don't know that we're going to land this plane perfectly, because there's a very big chance maybe markets go down more, maybe they quickly recover and you'll be very happy about it. I don't think that is the main why. It's just that you took advantage of a situation, but still it tied into your long-term goal and purpose of that you need to do a rebalance, an annual rebalance, or so, whatever your time frame that you're looking at it. That is the why, but you, in the short term, are getting a little bit of a sweetener there because you maybe harvested a few losses.
Yeah, and here's the thing. When it comes to portfolio construction and portfolio management, there's friction that exists when you try to rebalance, when you go to place trades, when you try to make adjustments. So one of the things we try to do when we look at our portfolios is we have acceptable ranges. Generally, when we rebalance, we want to do it because there's a purpose behind it. Perhaps it is loss harvesting and capitalizing on that. Perhaps there's something undervalued that looks attractive and we want to sell something that's overvalued, and we make that change. We look at rebalancing our portfolios often, but that does not mean that we are often rebalancing, because sometimes there's nothing that makes sense to change. If we have a target for a certain asset class at 11% and it's growing to 11.5%, we probably aren't going to rebalance that away because there's not a lot of value to be added from doing that. We think that it is the quality of the decisions that we make that leads to long-term success, not the quantity. Because if you try to do it too often, I worry you get in this habit of trading too often. And, if you rebalance now and the market's down 5%, well, then what are you going to do when the market's down 10%? I would say pick a time frame. Maybe it's every quarter, maybe it's twice a year, maybe it's annually. Look at your rebalancing strategy and let that inform how you go about making those decisions.
I do want to give Andrew a big compliment, though. I love the financial mutant mentality of when we have volatility, when things are going bad, when there's, things are bouncing around that emotionally it might make some people panic. I like that Money Guy listeners and financial mutants like Andrew get excited. They're looking for, are there planning opportunities? Are there ways that I actually turn this negative, turn that frown upside down to find a really good opportunity for myself? That's a win. And that's the mindset that's going to create even more financial success. So good job, Andrew.
And here's the last thing, and I'm sorry, I just got to add one more thing on
Yeah,
that.
that's fine.
One of the absolute best ways to rebalance a portfolio is through dollar cost averaging.
Oh, yeah.
A beautiful thing that happens is when you are constantly adding money to your portfolio, whether it be in your Roth IRA or in your 401k or in your after-tax account, and you have that money going in, as you make those monthly purchases, you get to kind of buy in the right bucket. So for a lot of our clients, we have dollar cost averaging strategies set up that keeps their portfolio pretty well in balance based on that. So if you are someone dollar cost averaging, maybe don't do a separate rebalance. Use those additional purchases as a mechanism to carry out that rebalance. Yeah. Andrew, that was a great question. I love that you were thinking about these things. Actually, wow, this leads itself really well. The second question is from Natish. Natish says, does it really make a difference if I invest lump sum versus dollar cost averaging for long-term investing? So he probably hears us talk about dollar cost averaging all the time. He's like, guys, does that really matter? Is that even something I should worry about?
Oh man, this is one of those things where you want to get people upset. Talk about either prepaying your mortgage or you talk about lump sum versus dollar cost averaging. This is the frothy stuff that us financial nerds get excited about. Here's the way to do dollar cost averaging right. First of all, I have to put the low-lying fruit. The majority of us, whether it's through employer plans, your retirement plans, or it's just because as you earn money, you get paid every 2 weeks or monthly, I want you to take advantage of dollar cost averaging on automating your wealth building. That's the first given. But there is a little bit of the art that goes in and intersects with the analytics of math when you come into a windfall or have money come into your situation and you're trying to figure out, do I throw it all in at once or do I just, put this in over a few months? Let me tell you the things you need to be thinking about. First of all, what's the size of it? The materiality to your net worth. And this is going to vary by your actual total. That's why I like people doing those annual net worth statements so you can know, hey, what's actually important and size-wise to me and material versus what's something that's just not that big of a deal. So if you're a person that has a 7-figure portfolio, say $1 million, you come into $50,000, hey, you're probably going to just lump sum that in because as a percentage of your total portfolio, it's not a huge deal. But if you're somebody with that same $50,000 comes in and you're worth $100,000, you might say, hey, I want to put that in over 6 months, and so that's why the size of what comes to your possession does matter. The second component is time. We have done a lot of research on this to figure out what's the overall impact of dollar cost averaging versus lump sum. Vanguard's done research on this.
Whole study on it.
And when they were looking at these trailing 10-year periods and looking at the performance, they found out that because you're putting this money to work, typically within 10 months, 12 months, that's when we come into a large lump sum. You don't want to go much beyond 10 months because then you are getting into the negative of dollar cost averaging, the fact that markets make money 8 out of 10 years. So if markets make money 8 out of 10 years, you can see that there's already a assumption or a default that lump sum is going to be better than dollar cost averaging. But if you can do it 10 months, you can see that now you've brought that time period down. What's your real exposure? Vanguard came in at right around 2% total. 2 to 3%. It was like 2 to 3% total. So you can imagine, and I'm talking about total return over 10 years. to me, that would lend itself if we were coming into, think about if you sold a business, you sold some land, and say it was life-changing money. You came into $500,000, you came into $1 million. By all means, I'm probably dollar cost averaging that over a period of time, because you know what would really stink? You get this lump sum, this money that's going to change your life, and then the market loses 25 to 30% the month after, the 2 months or 3 months after you received and invested that money. Think about those things, because the biggest part of what you're trying to do with investment plans is make sure that, like I said, you're getting the psychology as well as the analytics right, because they're all oftentimes in conflict with each other. Human behavior is, we got greed and fear, that are constantly in battle. And I'm always worried about, hey, what happens? What are you going to do that messes up your behavior, that derails your financial decision making? I think dollar cost averaging of large sums of money to your personal situation will really help mitigate a lot of that self, harm exposure that you might have as an investor.
I gotta be honest, I got nothing to add to that.
Oh man,
I was gonna say the last thing about behavior.
I'm sorry,
like 80%. I think it was 80% of personal finances behavior, but you nailed it. I'm just gonna toss them up and you knock them out. I love that. Here's the next question. This is from Racosta. It says, I've heard you mention that luxury vehicles should not follow the 23-8 rule. For those of you that don't know, 23-8 is our rule on buying cars. We say you should put 20% down. You should not finance for any more than 3 years. And your total car payment cannot be more than 8% of your gross pay. And that's for buying normal automobiles. If you want to buy a luxury car, we say that you have to pay it off within 1 year. That's what Racosta is elaborating here. And this is what he says. And instead, it should be more aggressive and paid off within a year. Can you elaborate why? So here's his question. Luxury cars don't fall into 23-8. We say you got to pay off in a year. Why? Why is that our stance? Why do we say that?
Well, I look at cars as they're obviously very important. And that's transportation. I mean, unless you live above a bakery and you work in the bakery, you got to make sure you can get to your job. So cars are an important part. And I've shared with you guys, I love, there's other financial pundits out there that say, go get the fixer up or go get the jalopy that you spend $1,000 or $2,000 on. I'm always worried. I'm not the handiest person in the world. I'm always worried, is that car going to crank? Is it going to get me there? Now, my brother, my father, who were very mechanically inclined, who worked on cars.
Fix anything.
Yeah, I mean, they go out there with some chewing gum and a paper clip. No matter what's going on with the car, it's getting them there. Buying a fixer-upper or that jalopy car is probably okay, but for me, I needed reliable transportation. So that's why I came up with, and we were discussing at 23.8, is because it does allows you to have a dependable transportation so you can get to your true way to create wealth, is to go make your money work by trading in a little bit of your time for money that you can eventually invest. And that's your wages and being consistent with that. So that's what 23.8 does. It allows you to get a reasonable car for a reasonable price, but not let your eyes get bigger than your actual wallet can afford or your purse can afford, where you're not actually investing. Because remember, a key component of that is you never want your car payment to exceed what your monthly investments are. That's because the driving factor to all this is, how are you making your money work for you instead of with your back, your brains, and your hands? And I'm worried with a luxury car, because cars they depreciate so rapidly, Bo. I mean, very few things in life do you have to actually pay to maintain something. It depreciates automatically. Normally, I know a lot of you trolls are going to come in and be like, oh, cars are appreciating right now. Yeah, this is a moment in time. It will get back to normal. Cars depreciate. They really can hurt your financial well-being. I don't want you buying that flashy car that says, look at me. Meanwhile, you're not building the silent component that's in the background that actually is the peace of mind, which is wealth. You've got to do the automated wealth building. Right. And that's what actually doing this will allow. So you can buy the Hondas, the Toyotas and things, but when you're trying to buy the BMWs and Mercedes, you should treat it same as cash. This should be a reward for a life well saved and lived, not something so that you can look good way ahead of time. And that's why I put that rule on there for luxury vehicles. It's because I don't want you faking it until you make it. I actually want you to start building that silent component, which is your wealth, which is your dollars that are invested. They need to be building so that if you see Brian driving a Tesla, Brian must have some bucks in the bank.
That's right.
It's not causing you to do this way ahead of schedule where you look wealthy. Meanwhile, you're rotting from the inside out because you never built any investments up.
And people will say, I see this in the comments, guys, it's simple mathematics. That doesn't make any sense. Of course I could pay it off, but why wouldn't I finance it? I'm going to argue that if you're in the position where financing that luxury car over 3 years versus paying it off in one is going to have a material and substantial impact in your financial life, you are not on as solid a foundational footing as you should be to be buying that luxury car. It's exactly what you said. And we do know, just like you said, luxury cars, especially if you're buying new luxury cars, they depreciate incredibly rapidly. So this prevents you from getting that situation where you're actually underwater on a car, even a luxury car, because they very well could depreciate more than 20% in that first year.
Well, I mean, and I don't have the stats right in front of me. We've covered it on so many shows. Maybe somebody can put it down in the comments. But a large number of cars, the reason balances are so high on what people are financing, they're financing it for now like 7 years or 6 or 7 years instead of the old 3, 4, or 5 like in years gone past, is because a lot of people are trading in cars with negative equity.
That's right.
That's what I'm trying to keep you from. Don't fake it until you make it. Actually create success for yourself financially and then reward yourself with that vehicle that's going to depreciate rapidly after you got your other financial bases covered.
Love it. Love it. Love it. All right, Brian, this next question is from Scott. Scott said, how would a custodial Roth fit into the FU? Trying to get the Army started for the next generation. I love that he used all of our language, because if somebody's stumbling onto us for the first time, Brian, why don't you explain what is a custodial Roth, what is the FU, and how does that fit into it? Where does that come in the order of operations?
Yeah, Scott, thanks for asking this question. What's funny is I normally don't like to do client calls and meetings on recording days because we're getting ready for this, but I had a client. He said, "Hey, he had some family stuff going on, but he threw in the stuff about custodial accounts for his teenage daughters." And so I'm fresh off of this, and then y'all know I have a daughter who's a senior in high school, and she works at Chick-fil-A, so she's got some bucks coming in. So you're trying to figure out how you balance this, and I love if you can get as a parent your children to become financial mutants by saving for the future. Well done, because there's so much data out there, Millionaire Next Door and Beyond and others, that show that we have an epidemic right now in the fact that most adult children don't leave the nest. They're not building those independence things. So you're trying to balance that. And then I had somebody on Twitter yesterday give us a shout out that we are one of the people they heard the best gift you can give your kids is to make sure you don't have to live in their basement.
That's right.
So, I mean, in order to do that, you have to prioritize you and your financial life before we can take care of the kids. And that's why financial order of operations, just like mathematics, have a way you need to solve a math equation to get to the right answer. Your financial life is exactly the same way. And there's two places I'll give you a shout out to. You can go to moneyguy.com/resources, and we have an actual free download of what those 9 steps of the financial order of operations. If you want to do a deep dive or accelerate your path, you can also go to learn.moneyguy.com, and we actually have a financial order of operations course that really can help you amp up how fast you adopt and make it through the process. But here's the key thing it's trying to do. If you think about steps 1 through 7, they're going to focus on you building the best version of yourself financially. It's not until you get to step 8 of the 9 steps of financial order of operations, which is prepaid expenses, and that's where the kids come into play. So I'm assuming, and hopefully you've done steps 1 through 7. Now we've graduated to step 8, and this is where I want to give you the greatest gift you can do for your kids. As soon as they start working and start making money, just like your employer has a matching contribution formula for your 401k or 403b, whatever you work with, you can do the same thing for your kids. I do a dollar for dollar match on my daughter's earnings, And I put it in there so she can see how this is actually, there is a behavioral thing that goes on. And then you know what happens, what affirms this even more, is I make a contribution. I mean, she makes a contribution. As a direct result of that, I make a matching contribution. There's one other person or one other entity that's also making a contribution. That's called the financial markets. And it is so glorious when they make their first $1,000. And then you say, hey, what do you make an hour? And they say, 10, 11 bucks an hour. I said, does it feel like you worked that many hours? You know, first time you make $100, you go, does it feel like you worked 10 hours? Yeah. You know, and then when you ask them, hey, does it feel like you just worked 100 hours? I mean, you quickly get to see, because you are trying to get the concept of you're trading your time, that's your labor, for money. Wouldn't it be great if you could trade a little bit of your money for time at a later point, and by the way, it's going to build in the background so you don't even have to work that hard. That's the concepts you're trying to set your kids on fire to get excited about, but you've got to make sure you do it in the right order. And that's why Bo hit on financial order of operations as well as the incentivizing the savings behavior. You're going to set them up for a life of success if you can get those things in.
Yeah, I'm just going to throw one other thing on there that I think is worthwhile. You asked the question, Scott, how would a custodial Roth fit into the FOO? Well, a custodial Roth is money your kid is earning, and so we said step 8, but maybe you're only on step 2 or step 3 or step 4 or step 5, 6. Your kid can still start their custodial Roth. Remember, because if they're out there earning money, they should be contributing to it. Now, you did say in your question, hey, I want to get the Army started for the future generation. And I know all kinds of parents want to do that. We are fortunate we get to work with wealthy people all over the world who have done very, very well, have been able to build some financial success. But not all children that come from those types of households are created equal, right? Some of the kids are financially astute and come out with a very solid financial understanding, and others don't so much. I love what you said that you do for your daughter. You didn't say, oh, I opened a custodial Roth for her and I just max it out every year. I just maxed it out. You actually made her put some skin in the game. We know that one of the traits of millionaires next door is that they don't have to provide economic outpatient care for their kid. Even starting early on, if you can get your kid to buy into it, there's a high likelihood that you're going to set them up for success, which in turn is setting you up for success later in life, once they actually get out of the nest and fly the coop. So I love this idea of a custodial Roth, but I also love it if you can make the child have some buy-in into it as well.
I was thinking about, because I made my daughter pay for half of her car. And as a parent that has resources, there was a lot of incentive to go buy her the latest, newest car.
Sure, safety and all.
Well, yeah, because now the new cars will keep you in the lane. They'll stop you, and so you don't run into something. And there's a lot of a lot of brain things are going on. It's like, man, as a father who wants to keep my child safe, I need to probably buy her something safe. But at the end of the day, I was like, nope, I want her to have skin in the game of this car purchase. And I think that is, it ties into everything you just covered, is that you are trying to train your children to have an appreciation of what a dollar is. That's right. I'll tell you, as two guys that don't come from resources in the beginning, but have built resources and then work with wealthy people, you worry about, are we screwing our kids up? And that's why you do have to create scarcity in their behavior, so understanding, so you can have those teachable concepts. Because if everything's easy, what are you setting them up for when they leave the nest? If you've given them the best all through their life, and then they go start working on their own, they're going to realize, what the heck am I doing? I never can have the life. And that's when they, I'm not saying that's why all kids live at home, but I do think that there is an influence if you're not trying to build some of those independent skills for your adult children.
Yeah, love it. So it's so interesting, Brian. We just talked about kids. This next question, again, you'd think I'd do this on purpose, but I don't. This next question comes from Garrett. He says, how do I approach investing with my wife, as she views the topic as gambling due to her family only investing in CDs to be safe? So she comes from a background where her family didn't do the investing thing. They bought CDs. And so she doesn't have comfort, doesn't have familiarity with it. what are some things that you would tell Garrett, or how would you approach that subject to like get the spouses on the same page?
I can tell Garrett's probably, I don't know if he's new to the show or if he's just trying to come up with some concepts so he can show his wife. But I mean, I love this. This does set it up in the fact that I've shared in content previously the story of two fathers and the fact that, you know, I grew up in a household very similar to what Garrett's wife expressed, where my parents' idea of investing was all CDs.
Sure.
That's all we did, CDs. Great with saving. By the way, that's one of the hardest skill sets of living on less than you make. My parents had so much right in the fact that they were great with their thrifty behavior. But when it came time to deploy the army of dollars, in a lot of ways, they were not maximizing, because CDs, you know, even if you look back in the inflationary periods of the 80s where everybody gets all excited when they hear that you could have bought a CD that paid you 7, 8, 9%. If you go look at what the financial markets were doing during that time, you're like, whoo, maybe that opportunity cost wasn't as good as I thought it was. I just was getting a part of the story instead of the full context. I think that I've shared that my father-in-law and my mother-in-law, you know, as a couple, were also very thrifty. You know, probably not, their incomes were not too different than my own parents with my wife, but my father-in-law was investing in the Fidelity Magellan Fund back when it was, man, rip roaring. I think it was, you know, it was bragging about 15, 20% returns for like a decade.
That's right.
I mean, it was pretty incredible. So you can imagine if you got one that's making 1 to 2 to 3% on their CDs, and then another person with the exact same dollars is making 15 to 20% a year, the separation in valuations is tremendous, and that's one of the things that that I would first bring up, Garrett, is that, and this is a big point. In the short term, people say investing is like gambling. And they might have some truth in the fact that, because it is a yo-yo.
If you're only doing it in the short term.
If you're doing it in the short term and you're throwing that yo-yo up and down, it is going up and down. And if you watch the nightly news or you watch CNBC or Fox Business or wherever you're getting your data, it looks like, what in the world are we doing? But if you zone out or pull the picture back a little bit further and go to 5 years and beyond, and especially at a decade, you realize you're no longer gambling, you're now wealth building, because I give the stat, and I even did it earlier on the setup for today's Q&A. Financial markets, investment markets, equity markets make money typically, especially the S&P 500, 8 out of 10 years, if you look at it historically. So 80% chance, looking at it each decade, that you make money. Very rarely has that ever not been the case. So you can quickly see that as long as you're not in those 2 years, and that's the thing, we never know when those 2 years, we could be in it right now in 2022, it could be next year. We don't know when those 2 bad years are. And that's why I always tell people, and Garrett, this is the way I would approach it with your spouse, is that let's put our money in different pots or buckets, in the fact that, is this short-term money? Is this mid-term money? Is this long-term? Short-term is really anything from 0 to 1 years. 1 to 5 years is going to be that mid-term money. And then anything over 5 years, you can start, especially 5 to 7 years, consider long-term. Those are different pots and they can have different strategies. And that's why you, with your retirement savings, especially if you're trying to convince, you know, why we need to do Roth IRAs, why we need to do employer matches and beyond, that's money you're not going to touch for 10, 20, 30 years in the future. Let's get it in there and let it be part of your wealth building process.
Garrett, my advice would be, if you're brand new, start with something small. For a lot of folks that I talk to that are like recently out of high school or recently coming out of college, and they're trying to figure out investing, but it's confusing because now there's cryptocurrency, and now there's AMC and stocks and ETFs and free trades and all this stuff. I say, let's start really, really simple. Let's open up a Roth IRA and let's start doing $50 a month. You pick the number, you pick the account type, and get her to just start doing something and say, hey, we're going to do this together. And every month, let's look at it and let's see what it did. And then in 6 months, let's look at it and see what it did. And in a year, let's look at it and see what it did. So that way she can start figuring out, oh, okay, I see how this works. Well, then you have to start playing chess. You have to start talking about, all right, what's the reason why we're investing? Like, what do we want? Okay, well, one day we want to have to not work anymore, or we want to be able to pay for our kids to go to college, or we want to upgrade the house, or we want to fill in the blank of the thing that you want to do. And then you just mathematically figure out, okay, well, here's how much we can save. So if all we did was put this in CDs from now until then, we'd have X amount. In order for us to do the things we want to do, we would actually need this amount. How do we bridge that gap if CDs aren't going to satisfy that? Well, here's a really interesting way to do it. And by the way, we've already been doing it in a Roth IRA. Yeah. So that way you might not get her excited about price to earnings ratios and looking at the trends and all that. What you can probably get her excited about is the why behind we invest. Hey, we got to put our savings somewhere. What's the place that we can put it to get our money working for us as efficiently and effectively as possible? But don't expect her to be on the same page as you are right now, because it takes some time to get there. And you have to be okay with it being a slower moving process.
Yeah, and by the way, there is a tool that really helps this discussion.
Mm-hmm. Yep. Go
do the net worth tool.
That's right.
We've been preaching the power of doing an annual net worth statement for years. Now we've actually turbocharged that concept. If you will go to learn.moneyguy.com, we actually have a net worth tool. And a lot of people go, well, yeah, I can go download any spreadsheet on there. Why would I go buy a net worth tool? It's really the dashboard.
That's right.
It's the bucket strategy. It's all the things that we built into the process that's going to help accelerate, because now you actually have a conversation piece with your spouse.
That's
and I think
exactly
that
right.
is such a powerful thing. We wouldn't mention it if we didn't think it would add value to the discussion. So go check that out too, Garrett.
Awesome. All right, here's the next question, Brian. This is from Sunder.
How many different ways? Are you throwing horseshoes hoping that you hit it right?
I'm hoping so. I don't know if I got it, but
because one of the easiest ways to upset somebody, get
their name wrong.
But say their name wrong.
If I say it 4 different ways, odds are I'm
Okay.
going to say it right. This is from
Have grace on both, please.
This is from what multiple of income should your house cost? Can you also talk about renting versus buying, especially in high cost of living areas? Thanks for your excellent content. I think Sundar has the same question a lot of folks have right now. Maybe he lives in one of the coasts or a really hot market. And he's trying to figure out, well, one, how much house can I afford? How do I know how much house to buy? How should I think about renting versus buying? Is there a right thing to do, a wrong thing to do? And then, is it different if I live in a different part of the country than, some other normal part of the country?
This might be a little bit of a wandering journey, but you'll bring it back into focus. Bring it back into scope. But I'll go ahead and answer, since I want to pontificate a little bit or get on my soapbox. Typically, it's 3 times your income.
Mm-hmm.
I mean, ties into things. I'm willing to concede that these are unique. I would even say once in a lifetime type things where you're like, man, just the weirdness of the moment has made me feel like saying that you should be able to go up to 4 times your income might not be the craziest thing if you're in some of these hot markets. And I even have an example. I mean, this weekend, my wife and I, because it's been cold here in Tennessee, the weather broke and we got it to like 53, 54 degrees outside, and the sun was shining. And my youngest said, "Hey, can we go for a walk as a family?" And how could you say no?
Absolutely.
When you get such cuteness saying that. So we start walking and we look down. Well, we get to the neighborhood that's right below us. And now look, there was all the playoff games that just started at 2:00 too here in Central Time. So I was like, man, somebody is having an awesome party here for all the pro football games and the playoffs. And then I started noticing the lines of people in front of 2 homes that had an open house from 2 to 4. I kid not. This is not an exaggeration. We had 30 cars in the area, and they were coming out. You would have thought that somebody was giving away something free the way the cars were piling in. And I was like, oh my goodness, this is for 2 open houses here in the neighborhood. This is how distorted this market is. And when you have all these people, it's going to create a feeding frenzy, and that's when you get the cash buyers, you get no due diligence. So my first advice, I've already given the answer of the multiple, but here's the thing I just want to give. This is going to sound somewhat conflicting, but I think you can use this as a guide to kind of a template to lay over your financial life to figure out how it fits. Is that I do want you to be somewhat aggressive in your thought process towards real estate if you're going to be in the area for the long term. Meaning if you're going to be there for the next, 7 to 10 years, the pricing becomes less important than it is if you're only going to be there for 3 to 5 to 6 years. But I also want you to understand, interest rates are going to have a dramatic impact. I've even talked to Daniel, and you and I have talked about it, Bo, that we need to probably show people the difference of what happens when your interest rate's 3% on your mortgage versus when it's 6 3/4, like my first mortgage rate was when I bought my first house. It dramatically changes things. So that's the positive or the nudge to take it serious and to really look at this, especially if you're long-term and you're in a good job like most financial mutants are, and your career trajectory is really good, because I give that encouragement. But here's the cautionary side. If we were doing the T columns with the pros and cons, don't lose your mind. All this stuff with throwing out due diligence and so forth is causing me to, I really just don't know that I like that, because I've seen situations where people know they have a dog, a dud, a problem with a piece of real estate that is going to cause significant issue on this piece of property, this house, for many years to come. This is the time to unload those doozies. Because it's just the protections. I worry about that. And a lot of us are not buying the land. You're buying the land with the house. Just don't lose your brain, because I think all seasons pass. I'm old enough now that I've seen bust of real estate. I've seen the boom of real estate. I've seen the same thing with the financial markets. It might seem pretty hopeless right now. And that's where I guess that answer of do you rent versus own, if you're in a situation where it's you're only going to be there less than 7 years, and you're really stretching yourself to where you're not saving anything, you're not investing, you don't have cash reserves because all you're thinking about is deploying it in this house, hit the pause button and know that this too will pass, so that you can kind of understand. So I hope because this is the part of why I know I'll never be out of a job as a financial advisor, is that when it comes to actually deploying your army of dollars, it gets complicated. There's a lot of variables, and I've tried to give you enough, breadcrumbs of how you ought to think about it and nuggets of information, but it is not, a black and white decision. There's a lot of gray built into the good financial decision making.
Yeah, there's two numbers I'll kind of remind you of. When it comes to how much housing you can afford, you want to make sure that your monthly housing service does not exceed 25% of your gross income, right? So take your monthly income, 25%. You don't want to go above that amount. Well, so that's like that's like the yellow line. The red line is you don't want all of your debt service across, if you have student loans, credit cards, auto debt, housing, all of that. You don't ever want that to exceed 35%. So you just kind of got to keep those two in your mind. Unfortunately, if you're in a high cost of living area, you do have to start thinking about, are there creative solutions I might think of? Like maybe even renting is a really high cost thing in a high cost living area. Okay, is there some way that I can get roommates? Is there some way that I can find a cheaper place to rent than a conventional place? If you're buying a house, is there some way I could potentially look at house hacking to try to get the cost down on that? It's a weird time, but you said it best, Brian. I think this too shall pass. We don't know when, we don't know how, we don't know what it will look like, but you don't want to stretch yourself way too thin and then have something catastrophic happen and you're stuck holding the bag. Because we saw that so many times in 2008 and 2009. Make sure you continue to abide by sound, solid principles that stand the test of time, and you'll keep yourself protected.
Yeah, and I'd kind of add two little anecdotes. I like, this is why we say if you're under 45 years of age, and in that messy middle part of your life, I don't have a problem with 30-year mortgages, because I think it will allow you a little more flexibility on what you can afford. And it's the same thing if it's your first home, not the upgraded house, but your first home. I'm okay with you putting down the 3 to 5%. There's nothing wrong with that. I know in financial dogma, it's typically 20%. But if you talk to other financial mutants and ask them how much they put down their very first house when they were in their late 20s, early 30s, you might be surprised to find out it was 3 to 5%. So I give you that grace to go put down less, go do a 30-year so that you can make a little more oomph with your purchasing decision, but don't lose focus on the why of long-term, because houses can be awesome, But I do worry, what is this? How does this all play out over the next 10 to 20 years? That's why you want to make sure you put those guardrails up that Bo shared so that you can make sure that you're kind of doing all things well. You're wealth building, but also creating a great house for your family.
Love it. Love it. Love it. All right, this next question, Brian, you want to answer a hard one?
They're not all hard.
This one is from Frank. Frank said, guys, I'm thinking about diversifying my portfolio. I've been looking at international stock index funds. They seem to be historically worse than U.S. funds. Should I be diversifying into international? Why? I'm currently invested 90% in the S&P 500. Brian, I'm happy to talk about like the international stock thing, if that's something, a direction we go. Here's what I really think Frank is asking. Should I diversify and why? Why is diversification a beneficial thing? I think that's really the crux of what Frank wants to hear us weigh in on.
It's so interesting because I look at philosophies of people I look up to or have had an influence in my financial life, and you can't help you just would be off if you didn't think about like Bogle.
Sure.
He came up with essentially the project that turned into Vanguard and really revolutionized the low-cost investing and loved index investing, but he was famously known for hating international investing. He just pretty much wanted all of his money here domestically. And you can't help if you look at the last 10 years of performance and you compare international and you compare it domestic, you're like, Bogle was a genius. I mean, this guy was... Forget Warren and his oracle from Omaha. Maybe Bogle was right with this. But I do think you have to realize reversion to the mean and other things that come into play is that, look, America's had a great run, and we're still going to continue. The whole world is going to have a great run. But is there some value to also having money in some growing economies that are outside the United States? And I would say yes. I mean, look, I think... You can figure out where your threshold is on this. I mean, are you a person that you think it's 10% and you would keep the other 90% of your equity exposure into domestic, or are you going to do a 75 domestic, 25% international? That's more personalized, and you can take it. I can tell you from my own personal, I am doing international as part. Domestic is the majority, but I do like the idea of thinking of this rising tide of innovation is helping all communities in the world, and I don't think that that's going away. So if there's a way that a third world community is going to become more, first world in the coming years, and I can invest and encourage as well as be a part of that success. Yeah, why not with a portion of it? Because that's what I love about investing in capitalism and other things is that you actually make money off of good things happening everywhere. So you just with that, and that might be oversimplified, but I do think that in the grand scheme, it's kind of a win-win. Yeah,
we live in a global economy that's becoming smaller and smaller and smaller. The further along we move, the further technology innovates, the easier it is for us to interact at any moment with entities and individuals all across the world. And I think that's only going to continue to happen, continue to accelerate. So it seems crazy to only be isolated in the part that you invest in and the thing that's right here, right in front of you. Now, if you look at history, the last 10 years, 15 years would suggest U.S. domestic equities have kind of been driving the boat, right? What we don't know is if that will continue. The whole reason why we believe in diversification when it comes to portfolio construction is we don't know what tomorrow will look like. It's crystal clear what yesterday looked like, but we have no idea what tomorrow will be. So we like to diversify our assets because who knows if we're going to enter into in the next 1, 3, 5, 10, 15, 20, 30 years, where perhaps there are developed economies or developed markets or developed companies that perform better than U.S. domestic companies. That's why when it comes to portfolio construction, it is very much dependent upon your individual risk tolerance, your individual risk capacity, and what you're trying to accomplish with your portfolio. So you figure out, how much do I want my portfolio to be on risk-on assets? How much do I want to be in risk-off assets? Inside of those risk-on assets, how much do I want to be in large-type entities? How much do I want to be in small-type entities? How much do I want to be domestic? How much do I want to be international? How do I want to use other types of assets like real estate or that sort of thing? And you essentially design a portfolio custom to your unique and individual situation. assuming that you're in the part of your financial life cycle that it makes sense to do so. If, Frank, you're someone who's starting out and you have 90% in the S&P 500, but me and you have a conversation, you tell me that your portfolio right now is $20,000, that's awesome. That's great. You should be focused on your savings rate, not your diversification strategy or your rate of return. We really don't think it makes sense to shift the paradigm on how you think about portfolio construction until your assets reach that critical mass. $300,000, $400,000, $500,000, then you can really benefit from diversifying your assets and looking at other strategies like tax loss harvesting or capital gain avoidance strategies, those types of things. Up until that point, concentration is okay, or what we really like are target retirement index funds, because then you do get a concentrated holding, but a diversified holding inside that concentrated holding. That's a great strategy as you begin to build your financial portfolio. Great question. All right, Brian, this next question is from Dr. G. Dr. G said, I have a question about term life insurance. My wife and I are 26. We're recently married. We have no kids. We do have a mortgage and we do have student loans. How do we pick a term life insurance policy? So what's the way? Let's answer the question first, Brian. Do they need term life insurance, or do they need life insurance? Question one. Second question, is term insurance the right kind of insurance? Third question, how do they decide how much to buy and where to buy and all that kind of stuff?
Yeah, we like term insurance. I mean, if you look at what we do in our own personal lives, I mean, I have a ton of term insurance. And truthfully, it's not, this is the good thing. You don't have to get all right on the first try.
That's right.
Because life evolves, life changes. I mean, but for Dr. G specifically, 26, married, have a house. You always have to ask yourself the question with insurance, because first, what is insurance for? It's to essentially fulfill the obligations. If you're unable to do so, it's to protect you from the dangerous stuff. And I think for a 26-year-old who's married, you're worried if you somehow got prematurely killed or died, now you got sick or something, you would feel horrible if you leave your spouse with a mortgage and other financial obligations where they're unable to fulfill and do that just because you're not able to earn an income and pay for it. Now, that's for a 26-year-old. Think about a 65-year-old who, a few years ahead, now this same person has a multiple seven-figure portfolio. Their house is paid off. You look at, if this person passes away, financially, it's probably not as a big of a shock and awe moment as it is an emotional, you love this person, you don't want them to leave, but it's financially not going to destroy the life of the surviving spouse. So now you can start to get a visual or a picture of what insurance is supposed to do for you between those two different scenarios. So that's why, since your needs will change over time, it's nice if you can buy cheap insurance to give you the protection, because also realize there's something competing in the background, especially when you're in your 20s, is you need to be saving and building. You don't get to that age 65 where the money's working for you and it's taking away the financial risk without building stuff over the time. Well, if all your money's going towards life insurance through like a whole life policy or something with big cash value deposits every year, where's the money you're actually building for that financial independence? That's where term comes in the fact that I love that you're basically buying the cost of the insurance, and you choose the term. Is it 20 years? Is it 25? Is it 30? You get to kind of determine that. And for a 26-year-old, maybe it's just the mortgage amount plus some portion of your income of a multiple of maybe 10 or some rule of thumb like that. But as you get older, you can take into account, especially when the kids are born, you can take into account education expenses and other things in that assumption. And like I said, it might become a ladder strategy. It's where every time you have a big life event, you're buying another term life policy. It's not uncommon at all when somebody has a brand new baby, you say, hey, you probably need to get 20 to 25 years of term insurance because you want to make sure that the child is through out of the house and hopefully funded a lot of their education goals. You can do that. You can add it as long as you're healthy. That's the only thing with term. And Bo, you might be able to shed some light on this, is what happens if you're not healthy and you were when you were 26, but you're not 35. I mean, what are there some limitations with term life insurance?
Yeah, Brent, it's interesting. What you just described is the exact thing that I did, right? My wife and I were going to celebrate 10 years married this year. And I want to say the first time that I bought an insurance policy was after we got married and had the mortgage and we moved across state lines, right? So she didn't have parents nearby and her family. And I was like, you know what, if I'm going to move this girl to a different part of the country and we're going to have this mortgage, I should probably have some life insurance, like keep it protected. I still have that policy today, even though I've added kids to the equation and business and all other stuff. We just kept bolting on, exactly what you said. So we started with kind of that base level, you figure out, is it the mortgage amount? Is it 10 times income, whatever it is? And then you adjust accordingly through time. And so you kind of have this like nice little patchwork quilt of insurance. Here's what I think is really interesting. I say it was almost the first insurance policy I bought. When I was in college and I was working with a large insurance company, I came up with this great idea because I believed this thing that I could build wealth in this insurance.
You were selling insurance.
I was selling insurance, right? I was doing an internship. I was selling insurance. I was like, I'm going to buy some for myself because I'll make a commission off of it and I can invest it. And it just didn't turn out. It didn't turn out really well. And I look back thinking, what the world was I doing at like 18, 19 years old trying to buy insurance? That wasn't a good time to buy insurance, nor was that a good type of insurance to buy. I love what Dr. G is thinking here. Low-cost term insurance to cover the basics, I think is a great way. One of the things I also love doing, I don't think you mentioned this, when it comes time to buy insurance, we love independent agencies, right? We love using an insurance agent. They can shop a bunch of different companies. If you go to an insurance agent that works for one company, odds are they can sell you one type of insurance from that company, and it may or may not be the least expensive. Whereas if you go with an independent agency, they can shop 4, 5, 6 different companies and different types of products, whether you want a 20-year, 30-year, that sort of thing. So it might make sense to look at that type of insurance agent to go buy a policy from. Is that where you're going with that?
Well, I mean, I think that's definitely should come into play. I mean, because most people don't realize your state insurance commissioners kind of regulate how. Yep. So if you buy online versus an actual agent, there's usually not a price difference because it's been regulated or curtailed by the state insurance commissioner. Yep. So, I mean, I always think about when things go ugly, if you have a good insurance agent, that's much better than a website. That's but right. the operative part there is it a good insurance agent? Because I always give the guidance, find the insurance agent or somebody they don't need to sell the insurance to you to pay for food for their family because they'll give you shoot you straight versus you might look like that Looney Tune commercial where, the person's the character's hungry and everything looks like a chicken, like a giant turkey looks like a turkey, a featherless turkey, walking around right out of the oven because that's the thing. I love insurance agents because they can help you if something goes bad, but just make sure that they don't look at you as their next commission check because there is a balance there. And look, we actually have insurance brokers as clients. If they're honest, they tell you they kind of agree with that. They understand when they were hungry. They probably did things a little more aggressively than when they had reached a level of success where they could be more consultants than salespeople.
All right, Brian, this next question, this is from Richard. Richard says, my wife and I are starting an HSA, a health savings account, and we want to max it out. Question, should we invest everything we put in it or should we save some to cover the deductible? So if somebody's hearing this question for the first time, perhaps it makes sense to talk about what HSA is, how it works, and specifically why Richard recognizes he is in a unique portion of the population that knows about investing it.
Yeah, we like health savings accounts. If you go and check out our financial order of operations on moneyguy.com/resources, or even if you go into our deep dive through the course at learn.moneyguy.com, you'll see step number 5 is going to have tax-free growth accounts, and one of them is health savings accounts. We love these accounts because they are triple tax advantage. When I say triple tax advantage, you get a deduction on your contributions. They grow tax deferred. And if you use them for qualified medical expenses, you will get to pull that money out completely tax free. That is really powerful stuff. There is a little bit of a catch. You have to have a high deductible health plan. It has to actually be an HSA eligible high deductible plan. You know, that's something you can always ask of your employer, or if you're shopping on an exchange, you know, you can look. Usually it's a box you can check in the filter to see if it's HSA eligible. And why are these plans structured? Why did the government create special rules for high deductible health plans? Is that they want you to be involved in your healthcare decisions. So typically the way this works is with a high deductible plan, just like the name implies, it will require you to have skin in the game or money through paying a deductible before the health insurance actually kicks in. I joke about the fact that most insurance these days is really just a big discount card, you know, because they're going to run it through insurance, they're going to discount it. You don't actually get to use health. Your insurance company isn't going to start writing checks for you until you put money in. So there's a chance. There's a few people out there. Maybe you're in the having children stage of life, or you know, you have medical, you know, ailments or things or struggles that you have high annual expenses, that maybe the PPO at your employer is actually better than the health deductible, you know, the high deductible plan. But for a lot of us, and it sounds like this is Richard, he's trying to figure out, hey, how do I take advantage of this? This is, I mean, it's a really good situation in the fact that you do get that tax deduction, but this is what Bo was alluding to. 96% of people who have health savings accounts use them as clearing accounts, meaning that you put the money into the account, you take your deduction for the contribution, but then your expenses for that year, medical expenses, you pull the money right back out. Well, you took advantage of one of the three triple tax advantage. So you hear that. Is 94%. Did I get that right first? Because it's 6%.
Yeah.
Because was it 4%?
Only 4% of folks actually do it.
So 96% of people are putting the money in, pulling it out, only getting the tax deduction. Meanwhile, that 4% are taking advantage of all three. And Richard's saying, hey, where does that crossover point come into play? And I always say I do think people should keep enough cash to basically cover those deductibles. Sure. So, you know, figure out what your deductible is in the plan. Also figure out what your out-of-pocket maximum is, just in case you had some big, huge medical thing happen, so you don't get caught swimming naked when the tide goes out. I mean, that's always a risk. But once you get that basic level of the deductible and understand where the out-of-pocket maximum is, let's put that money to work. Yep. I mean, that's what we have told you. We take advantage of that 4% part, is meaning that I am loading it up. I love that some of the big providers have gotten into health savings accounts like Fidelity Investments and others, where you can go open up an account, make sure you're keeping enough cash, but then start buying some index funds, you know, and other things to think long term, so you can get that tax deferred growth and then that tax free, you know, withdrawal once you're using it for qualified medical expenses. Because in retirement, medical expenses are going to be high. You will need the money. Take advantage of this stuff.
I'm even going to go a step further. Even if medical expenses aren't high in retirement, let's say for some reason you're just like super, super healthy, but you had medical expenses when you were younger and you're accumulating that, you're basically just boosting your tax-free dollars because you get to reimburse yourself for past expenses. I'm warming to this idea. I think the HSA might be my favorite type of saving. You know,
even over Roth IRAs.
I think I like it over Roths. Yeah. I think I like it over Roths.
That's pretty powerful.
Because of all the advanced flexibility that you have with it. Here's another little thing. If your employer allows you to deduct it from your paycheck, like make your contribution, it's actually quadruple tax advantaged, because then you can save on some payroll taxes with that as well.
Well, you could actually say Cinco tax advantage, because
Quinta
and the fact that you can also use it as a retirement fund. You still have to pay income tax on the earnings, but if once you're over 65, you can use the money for retirement expenses. I mean, just for anything.
All right, so if HSAs are my favorite type of account, my second favorite would probably be Roth IRAs. And this next question is from Rob. Rob says, should I max out my Roth IRA? I'm currently doing $300 a month before I max my Roth 401k. I just started this year with my company. I feel that my Roth has much better investment options available. I feel like we get this question all the time, Brian. Should I do Roth 401k or should I do Roth IRA? Which is better? What's the difference and why does it matter?
Well, obviously there's variables that come into play. I'm going to stereotype and say that I would prioritize Roth IRA over Roth 401k first, and that's why even if you look at our financial order of operations, you'll notice that Roth IRA is kind of that step 5, because here's the thing. Roth IRAs, you get to choose all the variables that come into play. You know, there's no excuse for how your Roth IRA is set up because you chose it. I mean, you got to go say, hey, who do I want to work with for my Roth IRAs? I'm going to work with a low-cost custodian like a Fidelity Investments or Charles Schwab or Vanguard. You know, there's a lot of control on, because then that puts you as really the field general of how do I invest the money? You know, low cost, you can do index funds. How much is the annual cost? And then what's the access points in case I needed to get to this money at some point? If you go look at your Roth 401k, now there's a chance you work for a big Fortune 500 company and they have an outstanding 401k, and your Roth is actually buying, your Roth 401k is buying into those exact same
low-cost index
low-cost things, maybe at a Vanguard or a Fidelity or a Charles Schwab. But there's also a chance that your 401k might be the college roommate or the golf buddy of the owner or the boss, the decision maker at your employer, and that it's just not going to be as good of a plan. You know, if it's an insurance sub account where, you know, they got a lot of fees in there and commissions and other things, it's just, and you still might use this account because you got to love the one you're with because the tax benefits, the matching contributions are so valuable, but it's just not maximized or made as efficient as possible as when the buck stops at you on that Roth IRA, that you control your destiny completely. And because of those variables, I put the Roth IRA first. Now there's a caveat. Income. Bo, you want to walk them through, because once your income. I mean, because not
thinking about something else.
Not everybody can do a Roth IRA.
That's exactly right. They put limits on it. Once you make over a certain income, they say, hey, you can't even do Roth IRAs anymore. We won't even let you contribute once you make over, oh gosh, I'm a butcher. It's like 140 single, like 200 married, somewhere in that ballpark, I think. Does that sound right?
Yeah,
I think
it's
that
close.
sounds right.
It's close. I'm so old, I still remember when those numbers were much lower. So since they're indexed for inflation, I'm always careful when I don't have my cheat sheet here.
But the beautiful thing about Roth 401ks, no income limit. So even if you make $1 million a year and you have access to a Roth 401k, you can still choose to put your dollars in the Roth bucket. Now, if you make $1 million a year, you may not want to because you're foregoing a really good tax benefit, but you can still do that. So for some folks, maybe you can't do backdoor Roths. Maybe Roth 401k is the only option you have for building tax-free dollars, and in your specific circumstance, it makes sense to do so. There's 2 other reasons I think the Roth IRA edges out the Roth 401k. Here's the first one, and we hate this one, but it's a fact. Roth IRAs can serve as an things went bad, emergency piggy bank.
Great point.
When you put money into a Roth, you can always get access to your contributions, your basis, tax-free and penalty-free if you need to. Once your money goes into a 401k, if you're still employed and working there, unless they allow loans or hardship withdrawals, it's hard to go get that money back. So Roth IRAs do serve as this like extra, only break the glass in case of emergency piggy bank. That's the first one. Here's the other thing that a lot of people don't recognize. We know that 401ks, when you get older, and IRAs are subject to required minimum distributions. When you hit age 72, you have to start pulling money out of those. Well, one of the beautiful things about Roth IRAs is that they are not subject to RMDs. Government does not make you start pulling money out of those at age 72. A little known fact is that Roth 401ks are subject to RMD. So if you've retired and maybe you had a Fidelity, had a Vanguard, and you just left your money behind there at age 72, if you've not rolled it into a Roth IRA, you're going to have to start taking distributions from that account. So Roth IRAs are a little bit better from a tax planning standpoint in terms of building legacy and passing assets on to your heirs.
Great points, Bo. Solid drop-ins. I love that's why we're a good team.
All right, this next question is from Alana.
Like Atlanta with or the city Atlanta.
I think there's no T. It's A-L-A. Maybe it's Alana. A-L-A-N-N-A.
I think we do everything in our power, and we're just going to blame it on our southern accents or southernness. We slaughter names. Keep going.
This is Al-Anna.
You are trying to upset our listeners. Don't do that. Keep going.
Does it make more sense to keep bonds in my Roth 401k, Roth IRA, or regular brokerage account? I only have bonds in my Roth IRA as part of the target date account. 401k is an index mix. Brokerage is S&P 500. So this is what it sounds like Alana is asking. I've heard you guys talk about like...
All I hear is the city name. Keep going. Keep going.
Man, you made me lose my train of thought. Here's what I think she's asking. What types of accounts do I hold different types of investments in? Like if I want to hold bonds, where's the best place to hold bonds? Now, unfortunately, she only gave us 3 options. I don't love any of those options. Yeah. Roth 401k, Roth IRA, or regular. How do you approach that decision-making process?
Since I'm sure we're destroying her name, which always upsets me because I want to get everybody's name as accurate as possible. I held off from going, every time you named off, like, because I think you said Roth IRA.
She's here. She just said, it's Alana.
Okay. Alana. See, you
Alana,
were saying it wrong.
Thank you. And by the way, this is why having the chat feature is so helpful. I can see it right here in front of me. This is Alana.
So Alana has, and I want to make sure I get this right. You had Roth IRA, Roth 401k,
brokerage
and then
account.
Taxable brokerage account.
Exactly
Those were the 3 pots. The one that would be the winner chicken dinner is the normal traditional tax deferred account. Is where I really love for bonds to be, because what's the problem with bonds, or what's the characteristic of bonds, is that they pay ordinary income, meaning that if whatever their yield is, that's going to be paid as interest. It's going to be ordinary income. So that goes into play. I don't love it in any type of Roth accounts usually, because that's where you want your tax, your growth assets. You want to stick it to our favorite taxing uncle as much as possible. So we put our growth assets into those Roth accounts to take advantage of that. Now Alana said something very important there, though, that you read out. You said it was part of her bond exposure was part of target retirement funds, or index target retirement funds.
That is her
so
bond exposure. So I'm
going to tell Alana to not look, if you're on your path to building $500,000 of assets, that base level of wealth building, let the index target retirement funds do what they're going to do. Because I want you buying the index target retirement fund in your Roth, your brokerage, and look, it does get in. This is the point, and we got show content coming out on this, is that I love index target retirement funds, but even they distribute income out. So anytime you get into that taxable brokerage account, that comes into play. But for bonds specifically, because that's what Alana was asking about, we don't love them in the Roth accounts. So that leads me to, maybe it could be okay in the brokerage out of those 3. If you're giving me a bunch of ugly things to kind of sort through, I'm going to probably use the taxable brokerage account, because look, there are 2 components, not only the interest of the bond, but there's also the principal of the bond. So if it went up in value, meaning you were able to sell it at a premium later, you buy a bond fund, or you buy a bond specifically, in addition to the interest being paid out to you, there's going to be a principal value that could potentially be capital gains or a loss with what's going on with interest rates right now. So out of those 3 ugly ducklings, my final answer is going to be brokerage accounts. I'd love to know what your thoughts are.
I agree with everything that you said, but there's 2 little...
I heard a but.
But there's 2 little nerdy...
There's a but in there.
There's some nerdy things I'm going to throw in here. First of all, Alana, if you're buying target retirement index funds, that's awesome, and we love that. I'm going to assume that means your portfolio has not reached what we would call critical mass for advanced strategies. But if you are saving, which it sounds like you are, you're going to get to that point where you have some critical mass, right, where you can do some exciting things. There's 2 things I would remind you to think of. Inside of your Roth 401k, if your employer offers a match, right? So if you're taking advantage of employer money,
great point.
Part of your 401k is going to be pre-tax, because your employer can't put money into the Roth bucket. So your Roth 401k is a great place, because some portion of your 401k is actually pre-tax. You didn't list it explicitly, but if there's a match in there, that's going on. So that would probably be the one that gets me.
Look at you finding a workaround. Right? Okay, that's dynamite. Let's see where you go next.
There's numero dos. One of the things we have to do is a lot of times we have clients who they sell a business or they've just been great savers, and the majority of their assets are in after-tax accounts. And we don't want to trigger a ton of taxation inside of those accounts by buying bonds, or we want to minimize that to whatever extent we can. Not all bonds are treated the same. There actually are a certain type of bonds that you can buy that are tax-free if you hold them inside of a taxable brokerage account. They're called municipal bonds. So one of the things, again, when your financial circumstance warrants, you may want to think about looking at municipal bond holdings if you're forced to hold them inside of an after-tax brokerage account. Now, that's not to replace all of your bond exposure. That's just an idea of a type of bond you can insert to satisfy that risk-off portion of your portfolio.
The only thing I would add to this is because when you get to that critical mass that you had already mentioned, this is one of the key things I love about being a financial advisor.
Exactly right. Yep.
Is because these are advanced planning strategies where we not only talk about the bucket strategy of how much money is after tax, how much is tax-free, and how much is tax-deferred, but there will come a point once you get over $500,000, so as you get closer to $1 million, you want to start paying attention to what you're putting where to minimize the impact of taxes as much as possible. That will come into play, and that's when, ding, 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 the abundance cycle completes the process where you graduate. Remember, the whole purpose here is we want you. We know this is years in the making. You're going to come here. You're going to take all the free information we're sharing. You're going to hopefully compare that to what you're doing in your financial life and saying, hey, is there something I could have learned from the Money Guy Show and apply in my life to accelerate? So learn, apply, grow, and reach a level of success that when you do reach that 7-figure mark where you're like, man, this thing, I am now the CEO of a pretty big operation. I don't know what I don't know. I have blind spots. There's areas of expertise that I would love to fine tune and make sure I'm optimizing. That's when the abundance cycle comes in. And that's why I love the win-win thing where you can come and take all this information, but there's still, you know what, we're laying our cards on the table. The why is I want to be an educator to you, but also this has turned out to be the greatest, business idea ever is for me to love and educate on you and then to turn you guys into clients down the road. I would just ask you to come join me on this journey. Come get all the free advice, but then go take advantage of our resources. Go to moneyguy.com/resources, tons of free giveaways there. If you want to accelerate that, because we're going to cover a lot of stuff. As you saw on these questions we covered in the Q&A today, we're all over the place. I mean, so you can become a financial expert by watching are we at 16 years? Oh, yeah, we're at 16 years of creating content. You can go find it and become an expert, or you can fine tune and accelerate the process by going to learn.moneyguy.com. And we actually have courses and tools that are going to hone in. Instead, you don't have to be a cat herder and go figure this out. You can actually grab it right off the cuff when we give you these courses that go right to the guts of what you need to be learning.
All right, Brian, you mentioned the abundance cycle. I love that. You mentioned learn.moneyguy.com. That's our deep dive. Maybe you just like free stuff. If you're someone who just loves free stuff, I've got 2 free things I'd love to tell you about. Go to moneyguy.com/resources. Check out our resource page because all of those are available to you. They are for free. They're to help you with your financial journey. And if you love getting great written content right in your inbox, go check out FYI by FTE. That is FYI.moneyguy.com to go check that out. Make sure you subscribe, and we will keep loading you up as you're on your path to financial independence.
I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team out. Take advantage of that abundance cycle.